Tyler Matheson in for Melissa Lee, coming to you live from Studio B at the NASDAQ. Upstairs from where I was the last time.
It is so good to have you. New spot.
Good to be here, everybody.
The light looks great on you.
What do you think of this? Great spaceship.
Great light for you.
A lot of empty space here that we're going to fill with quality content. On the desk tonight, Tim Seymour. You just saw him.
Yeah.
Karen Feinerman, Guy Adami, and Mike Coe. Thank you all for joining me. We start with the countdown to tomorrow's Fed decision. Stocks closing off their lows of the day. Still down across the board, however, as investors await the outcome of the central bank's latest meeting. Markets all but certain we're going to get a pause tomorrow, a skip meeting. Still, bond traders are looking for more hikes in the months to come. The yield on two-year treasuries posting their highest close since 2007. So what do these moves tell us as we head into the tail end of the year? Guy, why don't you go first?
Tyler, it is great to have you. So, listen, we play this game from time to time. If you had told me this, what would have happened? So 10-year yields today closed the highest we've seen since October, if not before October. I would have said the S&P's down 75 handles. Easy, given the run we've had and given where things are. We actually rallied 30 handles off the lows today and closed only down 10 points, which I think is remarkable. To me, it's all about yields. Higher yields are not good. It does not suggest the economy is getting better. It suggests there's not demand for our debt, number one, and then inflation is still a problem, number two.
That supply of debt that's coming online, that is doing nothing but putting a floor under interest rates, right? Because you got to bid up the price.
I believe that to be the case, and I don't think it's particularly equity-friendly either, Tyler.
Yeah. Tim?
Well, I think the long end has technical dynamics to it in terms of supply. I brought up the Bank of Japan. I brought up the JGB yields, which I think are going to continue to put upward pressure on treasuries. With Guy 100% in terms of what the price action was like today. It also came on a day, though, you could have also thought maybe there's some downward pressure, some terrible housing market data. I don't know that it's necessarily the kind that moves the bond market dramatically, but housing starts, especially multifamily, which have been the lifeblood of the housing market for the last 5 years, and which make a lot more sense in terms of a zero interest rate environment where a lot of those projects are profitable. And I just think that the housing market is starting to show some cracks. It's not, it's not a runaway train, but it's something where I think you have to watch it. You had CPI in Canada this morning, and to the extent that we love our friends up north, and yes, we look at your CPI sometimes, and it remains kind of sticky. So I thought the response of the equity markets was interesting as well, especially when you consider where we have seen the correlation to yields and equities. And I mean at least over the last few weeks. Largely, we've had this commentary. We had it last night. Our equities whistling past the graveyard of interest rates, and certainly forward PEs on the S&P and whatnot. But stocks are resilient here.
Karen, walk us through your Fed think right now. You know, if we had had this conversation a year ago, there would have been a certain category of individuals who would have said, well, by this time next year, i.e. right now, 2023, we're going to be looking at the Fed cutting interest rates. Nobody's saying that today.
Right. No, it's
a 24 thing if it's a 24
If it's a 24 thing, right. I think that so tomorrow it's sort of priced in they do nothing. I think that's the most likely, but I don't think it's over. I don't think we're at the end. And to your point, so if we're not at the end, then we can't be at the beginning of cutting. So I think we're going to be, in this higher for longer camp. And so I don't think the market has fully repriced that risk equity premium. But on the other hand, some tech stuff hangs in pretty well, right? The big tech names hang in pretty well. So we got a lot of cross currents here. We got, the consumer feeling stretched. We got oil has had this kind of quiet, really big run.
$6 a gallon gasoline in California.
So I actually saw a 7. I was there this weekend,
Whoa.
7 and change.
Whoa.
I guess people will pay it. I don't know. But it was...
Were you filling up gas for your lawnmower?
For my lawn? I don't know.
Oh, okay.
Why? Out in the island?
I mean,
No.
see Karen out mowing the lawn out there, Anyway. No, it's interesting because I think that the gas dynamic is something else along with what's going on with the auto strike and with what's going on with student loans. I mean, the Fed has got a lot of things to contend with here, especially in terms of growth. And it doesn't make the calculus simple going forward.
Yeah, as Karen said, there are a lot of cross currents here. Mike Coe, you're living in the land of $6, $7 gasoline. What are you thinking?
$6.29 a gallon at my closest Chevron. I'll just give you that little tidbit. I don't know what it costs everybody where you live, but yeah, we're dealing with some pretty high gas prices. High gas prices, high home prices, coupled with high interest rates. You obviously have a very pressured consumer here. And I think actually those are the two competing forces that basically help us understand how equities behave today. I think the reason that we saw us come off of those lows is that is kind of the behavior you would expect if you're expecting a pause, because you have those two cross currents going on. You have a pressured consumer, which is deflationary, arguably, but you do have higher prices in terms of energy and things like that. Obviously, the housing numbers that Tim was just talking about, that's not surprising. I mean, we have, just in terms of median home prices to income, they're at record highs, and you couple that with higher rates, certainly, than we are used to over the course of the last decade plus, then you're going to have, obviously, a very pressured housing market, and I think that's going to persist for some time.